Hello traders, this is Blake Morrow and you were listening to the week ahead video for June 14th, 2020. Happy mid-month. I hope everybody's having a great weekend right now. I am filming this a little bit earlier just because I have an event that I got to deal with tomorrow, so I just want to make sure that I got this video out to you in an appropriate time. So before I get actually into what's going on this next week, if you guys haven't tried out ForexAnalytix, make sure you do so. It's only $1 for 10 days. $1 for 10 days. And that gets you the premium version of ForexAnalytix. And it doesn't matter if you want to do the light or if you want to take the premium. It's just $1 and you'll get the premium version. Make sure you download the mobile app when you do so. You can do that at the App Store or the Google Play Store, and this way you get to see all of our features to the product while you're using it, and you can be involved in the chat rooms and all that fun stuff. All right, let me get rid of the data flash here. I'm going to get rid of that, and let's talk about this next week. Well, actually, I think we should talk about what happened the previous week, and then we can also talk about actually a couple other things. You know, while I'm looking at our product here, this is your basic dashboard. You'll notice that especially if you're a new user or a new user, you're a user that's you've been with us for a while, you'll notice that we added the news feed from LiveSquawk. It used to be powered by a different service, but we teamed up with LiveSquawk to give you this stream of news headlines here. Also, we have our live stream where you can actually get different updates to our analysis and things like that. Matter of fact, speaking of analysis, not all of our analysis is done yet for the weekend since this is being filmed a little early. So I won't be referencing all of the charts here on ForexAnalytix. I'll be referencing some. Speaking of which, we can just start off with the euro dollar. So as you guys may or may not know, with the euro rejected 114. 114 was a pretty big deal in my opinion, and the reason why the 114 level is a big deal is because it's actually a downtrend line from this specific data point right here in 2018. And let me go to the euro dollar really quick, and these are my charts because I didn't do the analysis over the weekend for ForexAnalytix. I do it during the week for basic technical analysis. So and I want to say it's the analysis that you get every evening, but I also do some of the intraday updates along with Steve Voulgaris, Paul Franco, Amanda. So you'll get analysis from the whole team, but I do all the end of day analysis throughout the course of the week on the ForexAnalytix platform. So therefore, on the weekend, I get to relax a little bit. So the reason why I bring this up is you can see that we had a key rejection of the 114 level, and as I posted in the blog, for those of you that are not members and you just you read like the chart of the day. Oops, you know what? We had a there was a on our on ForexAnalytix on the blogs. There's something up with WordPress, and we're having a little bit of a WordPress issue, so I'm not going to be able to reference that right now. But what I wanted to say is that I posted a chart of the day on the euro dollar. I want to say it was like Tuesday or Wednesday when we were up here, and we made this false breakout, and then we had a divergent relative strength. So we slipped to 112.50, which I said 112.50, then possibly to 111.50, and that seems like where we're going right now. It seems like we're going to be heading back towards 111.50. Now, there's a couple other charts that I really wanted to reference, in particular from this last week, because I think there are some key developments. First and foremost, the S&P. So the S&P slipped back to the 200-day moving average. You can see we closed the week, fortunately for bulls, we closed back above the 200-day moving average. But unfortunately, we closed outside of this, for the bulls, unfortunately, we closed outside of the ascending wedge. So therefore, as long as the S&P stays below, let's just say 3,100, the risk is for a continuation lower. If you remember my analysis from like a couple weeks back, I'd anticipated that we're going to go mid-range. We're going to slip in the summertime, and we're going to come back down towards this level. But we went this, rallying to where we went to the last couple weeks, went a little bit further than I thought. I didn't think we were going to make it all the way up to, the 3,200 level. I actually thought we were going to stall, closer to 3,000, 3,100. But I still feel that we're going to be slipping back towards like mid-range as we head into the fall. And the reason why I feel that way is that, I thought the seasonality of the sell in May go away was going to be an issue. I think, the market was getting a little ahead of itself as far as, its outlook on COVID. And we'll talk a little bit more about that. And then I had mentioned that, after going mid-range, where we go from here has more to do with after the fall, or as we get into the fall and we head into the election season, how the market starts taking in the idea of potential, Trump reelection or a Trump loss, and that's to be determined. But I do think that we are making our way back down towards, 27, 2,800. Just as I undershot the overshoot to the upside, I may end up overshooting the underside too. I mean, we could. Did I say that correctly? You guys know what I mean. We could end up going to 2,500 versus 27, 2,800. But I do think that we are going to be sliding back towards, like I said, mid range as we head into the fall. Now, like I said, as long as we're below 3,100, I think the risk remains lower. Now let's talk a little bit about COVID and the risk of COVID-19. As the numbers continue to come out over the weekend, what we're seeing in Florida, hot spots like Florida, hot spots like Arizona, where I live, unfortunately, the numbers of cases are increasing, and it's a little alarming, quite frankly. And there's different arguments to that. Well, and multifaceted as well. Are we hitting our second wave, or did we even peak from our first wave? And I think you could argue that we never even hit our first peak from our first wave. But the problem is that it's summertime here, and where I live, it's over 100 degrees Fahrenheit. It's very warm. So therefore, people are spending more time indoors. So when you spend time indoors in air conditioning, then you're circulating probably the virus indoors, which makes you more susceptible to to the virus. Now, if everybody thought, oh, it's 100 degrees outside, let's go hang out outside, it probably wouldn't be so bad. But that's not reality. The reality is it's really freaking hot, so everybody's indoors, and so they're probably passing around. Once you get the virus, you're passing around to family and friends and loved ones indoors. Even if you are limiting yourself to smaller groups, that's probably what's happening. I would guess. We're seeing some of our lower income communities in my neck of the woods that are part of the infection rate as well. So, there's different schools of thought, and frankly, I don't know what's what, but I do know that the numbers are increasing, and it is alarming. So that's something that will be a risk to the equity markets moving forward. Now, I agree with probably most of you that closing down the economy once again, or locking down again, is probably not in the best interest for the economy. And it's probably not going to happen realistically. It's probably going to just continue to, hopefully people are just going to be practicing and being a little safer. And, we get more to that herd immunity moving forward, but who knows? But right now, I think you can clearly see the equity markets are now being affected by this increase in cases of COVID-19, especially through parts of the United States. So if we're going to see now going back to the markets, if we're going to see a sell-off in equities, and what that's going to mean is a rally probably in the dollar. And so one of the key components about this dollar is that we held that. You can see this is the 88% retracement of this this whole move right here. We held the 88% retracement. I would not be surprised if the S&P continues to slide, that we see the dollar index continue to rally back towards, you know, maybe even 100, 99, maybe even 100 again. I think it's quite possible. And if you think about like what the dollar might be doing longer term, the dollar in itself could be, you know, making some sort of consolidation that looks like this. And so, you know, could the dollar index, you know, rally, you know, and then pull back and, you know, consolidate over the course of the next, you know, couple months? That's, I think, a realistic scenario. I don't think you can write off the dollar just yet, especially if the market becomes more risk averse. All right, and we're seeing not only the euro sell off, you know, and the euro, you know, that would actually put the euro back at, you know, 109 if that actually took place with the dollar index. But we're seeing, you know, a reversal in the cable from pretty key resistance. This was 127% extension of this move lower, right? And then also a 78% retracement of this move, okay, lower. That was a confluence right at 128 trend line. That rejected price. We are back below the 200-day moving average. You see the Aussie dollar, we made a false breakout. And it looks like the Aussie is, you know, we tested this uptrend line, but the Aussie dollar could very easily slip below the 200-day moving average, maybe even back towards the mid 60s, 60-cent level. Once again, but the Aussie looks like it's trading a little heavy, and I think we have to be careful of the Aussie if we break 68 cents. This is going to be really key support as we head into next week. Okay, you know, you take currencies like the U.S. dollar, Mexican peso. The U.S. dollar, Mexican peso broke out back above the 22.05 level. This was a major resistance. We broke above it, and I would assume that we, you know, garner some support down here. This is a 50% retracement. 618 comes in a little bit lower at that 22 level. I think the U.S. dollar Mexican peso is going to be pretty well bid, and if we break back above this this 2290, this breakdown point, it's 2285, 2290. That's gonna, you know, that's gonna take the U.S. dollar Mexican peso back up towards 24. So the U.S. dollar Mexican peso is very much a risk on, risk off type of currency, meaning if there's risk off and stocks are coming down, the dollar Mexican peso should continue to strengthen. One of the currencies that I haven't been trading a whole lot, but paying the close attention to is this US dollar Japanese yen. The US dollar Japanese yen, I traded it last week, or a week and a half ago, but after almost completing the inverted head and shoulder pattern here, we broke back through this trend line, and you know, the dollar yen and some of the other yen pairs, I mean, if we break through 106, it could be quite a bearish event, because if you take this fib level that's holding the 78% retracement, if you start talking extensions, you know, we could trade back down towards 105, maybe even as low as 103.60. That would be a risk if we really start breaking down here, you know, below the 106.50 level. So there's a lot of potential in these yen pairs to move lower, and they would probably be moving with risk aversion, risk appetite. Again, if stocks are coming down, the yen crosses would be coming down. That means the yen would strengthen. Okay. Now, heading into next week, there are a couple of key events this next week. We have retail sales on Tuesday, which will be, you know, will be watched, obviously, because we want to see how the consumer is responding to the you know, the lockdown. You know, it's hard to bet against the American consumer. You guys know that, but we'll have to pay attention to that. We have Australia employment data this week. We also have Super Thursday. So if you're trading the cable, remember the Bank of England rate decision is going to be on Thursday. Also on Thursday morning is the Swiss National Bank as well. So if you're out there trading the Swissy, which, you know, the Swissy, let me get over to it real quick. There it is. The Swissy came out of a real, you know, big triangle, and we've managed to find some support down here, 161% extension, 618. We obviously went a little bit further, but this 94.50 level is going to be pretty important for the Swissy, as far as support goes. Also, one thing that's kind of being overlooked, but make sure that you pay attention to, especially if you're trading the euro. We have the EU Council meeting on Friday, and it starts at 4 a.m. Eastern. Okay, so for those of you guys that are on the East Coast, it's to be at 4 a.m. I believe, what is that, at 9 o'clock in the morning, GMT, 9 or 10. But just remember, there's an EU Council meeting. That means we're going to probably see some headlines late in the week regarding the euro that could obviously have a very big influence on the euro dollar itself. But pay attention to the euro crosses, whether you're talking the euro Aussie, which I think is a currency pair that you got to be paying attention to right now, especially if we get back above the 200-day moving average. We start breaking above 166. This currency pair is probably gonna make a break for the 170s again. So I would pay very, very close attention to the euro crosses going into the end of this next week, and also I guess one other currency pair you should probably be paying close attention to is the euro pound, especially with the EU Council meeting on Friday, the Bank of England on Thursday. This currency pair could be really set to break out of this range right here, which you're talking 88.60, I believe, and then 90, let's call it 90.50 pence. Okay, this range that we've been in for the last few weeks, we are likely to break out of this with those two events at the very end of this next week. So just pay attention to it. And I don't know which direction. I'm just saying that I think a breakout is looming. So guys, if you are watching this video and you think it's going to be beneficial to you going into this next week, make sure you give us a thumbs up if you're watching us on YouTube. It makes myself feel better. It makes all of us that put in the effort over the weekend in delivering you this free video, makes us all feel better, the whole team. And then also subscribe to the channel if you get an opportunity, so you can listen to the F.A.C.E webinar every day, but you don't miss any of the great interviews that Dale Pinkert does throughout the course of the week. There should be a link in the description to subscribe to that webinar, so you can watch it every day. It is free. And guys and gals, I want to thank you all for being part of my life and listening in today. And I hope you guys are having a great weekend, being safe, enjoying your summer the best you can, with your family and maybe some close friends. So we'll talk to you soon. Oh, one thing I wanted to mention also about this summer, usually we go into the summer doldrums, and the summer doldrums really stinks. It's horrible. Everybody's on vacation and the FX market's really quiet. Well, since no one's really vacationing, I think it's going to be busy all summer long, which is good for all of us, looking for volatility. Plus, with the elections coming up this fall, it should be a doozy. So this summer, I'm not expecting the doldrums like we usually get from a seasonal standpoint, since no one is really vacationing. Everybody's stuck in front of their computers, so we're all trading. Anyway, my name is Blake Morrow with ForexAnalytix. Thank you for those of you that support us. Thank you for those of us that spend every day with me in the chat rooms. And for those of you that listen in and support our company, I really appreciate it. So have a great one. I'll talk to you guys on the F.A.C.E webinar on Monday. Thank you.